So I look at the gold price as really the inverse of the dollar price. I mean, to measure gold in terms of dollars, it's like you're standing on the deck of a ship, which is slowly sinking because it has leaks in it, and it's tossing around in stormy seas. And you're measuring the altitude of the lighthouse relative to the deck you're on. And we're saying, the lighthouse is going up right now. When is it going to start going down again? And I just think we have the wrong perspective. And I think, the lesson of that story is that can that they keep kicking has a lot of kicks left in it. Because what's going to change that would get gold back into a bear market? What's going to change right now? Well, it's hard to even conceive of what that answer would be.
Hey guys, welcome back to Capital Cosm. Mr. Keith Weiner, thank you so much for coming back on the show, my friend.
Thanks for having me, Danny.
Yeah, always a pleasure. So, hey, Keith, let's go ahead and dive right in. Give us your kind of like 65,000 foot view of the economy at the moment. What are some broad strokes that you're seeing?
Broad strokes. I'm not seeing de-dollarization. I don't know how big that rumor is
Hmm.
amongst your, viewers. Um, there's something that's been coming in slow motion. I've been talking about it for a long time, which is they've hiked interest rates. Before interest rates rose, 20% of all corporate debt was so-called zombie debt. Now, zombie is a term defined by the Bank for International Settlements. That's the central banker's central bank. And it basically means a company whose profits are less than its interest expense. And it's not an open-ended upside, kind of situation like a Tesla or an Nvidia. It's just a company that's trudging along and ain't going anywhere, and it doesn't really have a way out. 20% of all corporate debt was zombie. That was when interest rates were zero, and corporate rates, even for zombie, debt, was probably in the 3% range. Now they've hiked rates to 5.5% on the Fed funds rate, and zombies, I'm sure, are paying 8 or more. How many more companies are zombie at this rate? Well, they haven't released an updated statistic that I've seen, but defaults are coming. You already see it in commercial real estate. You're seeing it on the edges elsewhere. I can tell you out there in startup land that startups are not raising capital. Um, those few startups that get any money at all are getting 10% of what they were seeking at a much lower valuation. A little bit of a boast here, a little bit of bragging. We were about 11% oversubscribed in our round at the valuation we were seeking. So we did very well on that. But for the most part, credit is contracting from the margins. So you see it in the resource, sector. Those companies are starved for credit. You see it in a lot of other places, startups, as I said. Um, and that's one of those things that doesn't matter until it matters. It's not a problem until it's a problem, as the authorities would see it, which is when the defaults really start heading, and that's when debt is maturing and has to be rolled over. They either can't roll it over, or the interest rate is so much higher they can't afford to. That's when the problems begin. And so, to me, everything else is downstream of that. GDP, stock market, unemployment, it's all downstream of the credit and the credit event that they've set in motion. The other ironic thing that I observed, I don't remember if we talked about this the last time I was on your show, was zero interest rates cause many harms. If you're willing to ignore all the harms and focus only on consumer prices, and you said we want lower consumer prices at all costs, you should want lower interest rates rather than higher interest rates. And so I'll take an example of something that people are really starting to complain about now, at least on Twitter and social media, which is their insurance premiums are skyrocketing. And everybody thinks that that is specific to one kind of insurance in one state. Oh, well, California, that's because of the wildfires, or that's because of the coastal erosion and the mudslides. Oh, well, that's Florida and, hurricane risk because of global warming. Oh, well, that's just car insurance rates in Denver because of, too many car thieves. Everywhere you go in the globe, not just in the United States, and every kind of insurance, car insurance, um, homeowners insurance, directors and officers insurance for corporations, it has all skyrocketed. Why? Because the Treasury has starved the credit markets. Why would you put capital at risk with an insurance company when you could put it in T-bills at 5.5%? So the insurance companies are finding their cost of capital is much, much higher, which means the returns they need to get are higher, which means they need to set much higher premiums. When they can get capital at all, and if they can't get as much capital, then the balance sheet has to shrink, which means that they can't write as many policies. And so we've just made insurance scarcer and therefore more expensive, but jacking up the cost of, you know, raising capital in the insurance portfolio. And the same thing occurs whether it's hamburger producers, hamburger grill producers, the companies that produce the machines that make hamburger grills, on and on and on, all the way up the value chain. We've hiked the cost of capital, which means we've hiked the hurdle rate. Every business has a return on capital that it must achieve or else be liquidated. That hurdle rate is now much, much higher than it had been before interest rate hikes. And so everyone's thinking, is this enough hiking? Are they holding it for long enough? And I'm like, you've got the sign backwards. I remember, I think this was in the 1980s, they aborted a space shuttle launch when they realized that the computer had programmed the gravity of the moon as negative, as a repulsive force. And obviously, if you had launched anything with that assumption, you would have, overcompensated for it, crashed it into the moon probably. So fortunately, they caught it and they just aborted it, and it was a minor embarrassment, and they moved on and fixed the bug. That's what the monetary authorities have done. They've got the sign backwards, and and they're going to cause consumer prices to rise if they keep it this too much longer, because they're going to force the destruction, the liquidation of so much productive capacity. So you asked for my short take on what I see going on. These are a couple of things that I see going on at the moment.
It's kind of counterintuitive because the narrative goes is that hiking interest rates would lead to lowered inflation because it provides, yeah. But what you're saying is it's actually creating more supply side inflation. And you also see this in commodities, for example, these big expensive projects to develop a mine, to explore a mine. These are all heavily capitally intensive enterprises, projects. It takes like $1 billion to build an oil rig. Now, all of a sudden, you put an additional layer of pressure on the supply side. Now you've got further supply side inflation. So no matter what they do, whether they try to turn the dial this way or push the knob down this way, it appears that it just makes things worse, right?
I gave a talk at a conference in Vienna, Austria, where they kind of regard me as a long lost son because of my last name. And I don't really speak German, but occasionally I learn certain words. Anyway, the title of my talk was, I'm going to try to say it correctly in German, but I'm sure any German speaker is going to say I butchered it. The word would be Zugzwang, which in chess you would see it as Zugwa, Zugzwang, which is when in chess you have to make a move, of course, you can't pass. And any move you make weakens your position. You'd rather pass and let force your opponent to make a move, then you could win. But because you have to make a move, you're going to end up losing. And I think I said, the title of the talk was something like "The Fed finds itself in Zugzwang." Anything they do is only makes it worse. And that's after, 111 years of central planning, and what are we at, 52 years of 53, going on 53 years this August of having a completely irredeemable currency tied to nothing. And which means the interest rate is completely unhinged after 1971. It means the debt necessarily, not because, Congress doesn't have any discipline, which is true, not because the voters vote for more welfare, which they do, necessarily the debt has to grow exponentially in an irredeemable currency system. So we pay debts using dollars, and the dollar is itself a debt. It can't extinguish a debt, and the debt grows exponentially. So after 50 some odd years of this, they've hollowed out the system. And, you have crisis on one side, so you're driving on that highway between Wyoming and Idaho. I saw the pictures after the collapse, but it looked like it was a pretty narrow, piece of land that, there's a highway on top of it. And then either side, you drive off the edge.
Yeah. So it kind of dovetails into my next question, which is the Fed came out the other week and they actually said that they don't anticipate any more than one rate hike until the end of the year. Now, the market's ripping higher than ever. But this begs the question is, what do you think will be the impact of higher for longer? You've mentioned all of these. We're at the precipice of a banking crisis. Can these banks continue to stabilize at 550 basis points Fed funds rate the way that they are? Or are they just going to keep pushing off rate cuts until, as cliche and as trite as it may sound, until something breaks? Tons of people have said that, but that doesn't mean it's not true. What do you think?
The analogy I like to use is that the Fed, apparatchiks or bureaucrats are kind of on the ivory tower, but it's a really tall ivory tower. It's like 100 stories. So they're all the way up there, and they're looking out the window and say, "Oh, I do say that the ants, people ants, look like they're running around. They seem to be a bit upset. Oh yeah, a spot of bother down there." Um, and they're not going to necessarily notice until things are on fire so badly, the flames are looking up 100 stories, and then all of a sudden they respond to that. The other thing that's going on, there's a big difference between the 2020, let's call it the Powell Fed, and the Bernanke Fed in 2008, and that is the Fed at that time. Today's Fed, the Powell Fed, would say that that Fed was asleep at the switch, that they were not proactive enough in averting the crisis. Now, I would say they precipitated the crisis by hiking interest rates as they did, 2005. And it took, so look, it took 3 years. Or I think they started hiking in late 2004. I can
Mm.
remember when the first hike was.
But there was a lag. There was a lag in their rate hikes.
Yeah, because a couple of things. One is, you hike rates, but most corporations have bonds of some sort of maturity, and they don't really feel the pain until the bond has to roll. Then all of a sudden, there's a big crisis, right? And so, depending on the average maturity of all the corporate bonds, you have to look at a graph of where the wall of maturities hits, and so forth. Number two, at least as far as layoffs go, the post-crisis Fed has precipitated and then averted. I'll get back to how they avert things in a minute. So many little crises every time. So as the economy tips into recession, or when it does, if you're running a major corporation, the thing to do is lay off as early as possible and as aggressively as possible into the downturn. And that way you save as much precious capital as possible, that any investment you're making at that point isn't going to pay off because your market's shrinking and your revenues are going to drop. Then, as soon as the signs of the bottom are in and things are turning, you want to invest ahead of all your competition, and then you'll permanently take market share from everyone else who's gotten wrong-footed and offsides. They lay off too late, so they don't save as much money. Then it's more of a crisis. Then they lay off too much, and they're laying off into the upturn, and then you're taking their market share while they're in chaos. That's so that's what you're supposed to do. Every time there's been any sign of a downturn post 2009, the Fed has like trained everybody like Pavlov's dogs that we're not going to let it happen. And every company that started to lay off regretted it. And we're going back to beg the people that just laid off, please take your old job back. We'll double your salary. We'll do all this and that and the other thing for you. And so after X number of times, or maybe it's the boy who cried wolf is maybe a better analogy. After X number of times of it, everybody's extremely reluctant to lay off because the Fed has been very proactive. And I wrote an article where I liken it to take that analogy of a squid, a vampire squid is what some people call it, or Matt Taibbi I think called it. But to take the analogy of a squid, every time there's a hole in the dike that begins to leak a little bit of water, the squid finds another little tentacle, maybe more of like a kraken, to plug the hole. And so the Fed today is like hyper proactive versus the Fed in 2008. There were still some rules that said you can't just go willy-nilly and just anything and everything, whatever, whenever. And today they've basically thrown all the rules into the dumpster, do whatever the heck they want, and they're extremely aggressive. So one thing that I tell everybody to watch is the spread between junk bonds and treasury bonds, which, if you're heading into a crisis, it's the junk bonds that are going to default. And for any of your viewers who think the Treasury is going to be the one that defaults, because look at how much debt they have. The Treasury will be the absolute last party on earth to default. They're the ones with the printing press, right?
Right.
It's everyone else, every corporation, every local government, city, county, state government, corporation, business, every consumer who buys a house or car, every foreign government, every foreign corporation, every foreign bank, everybody that doesn't get the Fed's bailouts or the Treasury's bailouts, those are the ones that are going to default. And the uh, the junk bond spread has not widened massively as you'd expect it to in a real crisis. So until that happens, nothing can happen, and so stocks are free to get bid up, and everything else. Once that spread starts to blow out, then I'd say, heads up, something's something's happening.
What do you make of the gold market at this very moment in time? Gold sitting at 2,300, silver is just under $30 at $29. We had a pretty rapid move up in both prices actually. What does this portend? China just recently announced, well, they didn't actually announce it, but it was reported that they may have pulled down their gold buying recently, hoping to see the price come down and correct a bit before they re-engage. And also, simultaneously, they just continue dumping treasuries. They're dumping treasury every few months or so on Twitter or X, whatever you want to call it. I see this graph, and then I just see another tick down in Chinese U.S. Treasury holdings. So, what does all this mean? Why is China dumping treasuries? What does them kind of cooling off from purchasing any gold, at least in the very short term? What does all that kind of portend?
So first of all, nobody should trust data out of China. It is so opaque. It is so centrally planned. Their central planners tell all the regional planners, this is what number you will produce. And the regional planners tell the city planners, this is what number you will produce. So, they could be buying while they say they're not buying. They could be buying more while they say they're buying less. They could be buying more while they're actually saying they're buying more. I mean, who knows? I wouldn't pay that a lot of credence. Um, the reality is that everybody with any wealth in China is desperate to sell the yuan. And of course, that's illegal. They've made that a criminal act. And in a place like that, you don't want to break certain laws, and that's definitely one of them. I mean, they will do really bad things to you, but people are doing it anyway. So, like, every once in a while, they ratchet up the capital controls, but people are finding ways to violate them, which means their currency is under selling pressure. Every native, Chinese who's forced to hold it wants to sell it and get dollars, and they're trying to stem that tide, and but the wall is leaking. So, but they have a peg to the dollar, so they're forced to defend the peg. And every time they're selling, they either watch their currency go down or they have to buy it and sell dollars to do so. So, in my view, de-dollarization is when all the dollar juice is sucked out of a currency, and when that happens, the currency is finally a dry husk that's dried up and worthless, like the Zimbabwe dollar was, and like what's probably happening to the Venezuelan bolivar, possibly happening to the Turkish lira, probably going to happen to the Argentinian peso, not because of Milei, but probably far too little and certainly far too late. Um, and sooner or later to the yuan. So they're trying to defend it, and that's what defense looks like. I don't think they're selling as much as is believed. I think what's quoted as the value of their treasury holdings, and given the massive increase in interest rates, long-term treasuries fell by 25%. I think the bulk of what appears to be selling is actually the decline in value in market price, which is a whole different thing anyway, and that's the same for everybody. But I think, and how to tie this into the gold market, there's four major worlds that are buying gold, while the Western world is largely not. I don't think there's a huge amount of sellbacks, like at retail, where people are bringing their gold back to their dealers. I don't think there's some of it, but I don't think there's a massive amount. So I don't think all the people that bought gold over the last 10 years are suddenly in a rush to go dump it. But there's certainly a hiatus in buying, and volumes have dropped by 50 to 75%, depending on which dealer you talk to. But in these four other worlds, they're buying regardless of the fact that the gold price is up. They're buying in China, they're buying in India, they're buying in Turkey, and they're buying in the Arab world. And for 4 different reasons. So in China, it is definitely a distrust the government, distrust the currency, distrust the banking system, distrust the investment markets, and they want something they can hold that's outside of all of that. And if they can't get dollars held in the U.S., then they'll get gold, which the Chinese government does allow them to have some of. So they're buying, and I believe that is spread to all over Asia. Vietnam, Malaysia, other places like that. They're buying gold. Probably as a follow-on. And of course, the Chinese diaspora is pretty saturated through Asia anyway. There's a lot of Chinese people of Chinese descent in Malaysia and obviously Singapore and places like that. In India, you have, they always are buyers of gold whenever they can afford to, whenever there's a decent harvest, because the rupee is designed to go down relative to the dollar, and it's pretty successful at going down. I think it's something like 7% a year against the dollar, let alone how much the dollar is going down. So they're always buying gold, and I think with greater urgency now, and probably the quality of their currency is taking a down leg. In Turkey, there's arguably incipient hyperinflation. And so everybody in Turkey would have at least 10 grams of gold, is what I'm told. You go walk through the Grand Bazaar in Istanbul, and I didn't see it before now. I saw it last year, but I must have seen 100 different gold shops, of all kinds of different styles. So you have the Indian ones, you have the obviously Turkish ones, you have the Arab ones, and they're all different styles that they sell, but they're all selling gold, massively there. And people are protecting themselves against collapsing currency. Finally, you get to the Arab world. Now, parts of the Arab world, let's say Egypt, are under real stress and real, potential crisis. Other parts of the Arab world, let's say UAE or Saudi, nobody there, the currencies are pegged to the dollar. Nobody there really has to worry that they're going to wake up tomorrow morning and the currency is going to be 80%, hacked compared to, yesterday. That's what happens in places like Argentina or Venezuela. There's an official exchange rate. Tomorrow morning they devalue it and everybody's just, robbed. That's not really a concern. And those pegs in the Arab world are stable. So in places like Egypt, I'd say, yeah, they're buying gold to protect themselves against what may be coming. But in places like UAE and Saudi and the other Gulf states, I think they're buying there. If there's any of these four worlds that are arguably anti-US dollar, anti-US monetary policy, it would be there. That they love Americans, certainly in UAE. I've not had any problems. They don't love American monetary policy. They realize they're kind of on the short end of that stick. And so they're buying gold to get out of that a little bit. And so that's where all the buying is. It's not in America, it's not in the UK, it's not in Western Europe. Even Germany, the famous big buyer of gold in Western Europe is kind of on hiatus. But those other four worlds are not. So that's why you have seemingly quiet gold market. It's not quiet over there, by the way, it's quiet here. Near record or near record gold prices.
Hey guys, quick pause. Have you ever dreamed about seeing any of the cool guests that we get on Capital Cosm or that you see on these other YouTube channels in person? Well, now you can. We can see Rick Rule, Adrian Day, Danielle DiMartino Booth, Dr. Nomi Prinz, Grant Williams, James Rickards, Lobo Tigre, and more. You can do so by joining the Rick Rule Symposium, July 7th through the 11th. You can register now. Link to that is down below. And it takes place in Boca Raton, Florida, on a beach resort. You get to meet all the cool people that you've been watching on YouTube, and you get to do it beachside, on a resort. What more do you want? If you're interested, link to that is down below, and let's get back to the video. So let's stick to the Middle East for a second. Last week, the Petrodollar quietly came to a close. The deal expired. It was a 50-year deal. It expired last week. Now, you haven't really heard much news come out of the MSM, the mainstream news. But it didn't kind of make the rounds on X. You do kind of hear about it here and there on YouTube from various channels, but it's all very strange. Why is no one talking about this, Keith? What the fact that the longstanding petrodollar has just quietly come to an end, and then also, what does this actually mean for the dollar? Number one, and then number two, does this have any downstream effects on gold and price of oil?
Well, I was gonna say that's why there are certain folks that are touting it on I still call it Twitter, X, um, is they want to create a sense of urgency. The gold price is about to go up to get retail people to buy because they're in the business of selling gold, or they're paid by companies that sell gold in order to write stories that will sell more gold. Um, I think so. I wrote an article a couple of years ago called what was it, Gold, Oil, and the Dollar Go into a Bar? Something like that was the title. And I was talking about, this exact issue. And I don't know if I'm named Petrodollar, but kind of about that concept. And I use the example of, suppose your front yard is getting kind of long, the homeowners association's writing you letters, and then this neighborhood kid rings your doorbell and says, "Hey, mister, I'll mow your lawn." And you say, "How much do you want to charge?" And he says, "One box of ice cream sandwiches." And then you're like, "Okay, I think an ice cream sandwich is about $1, and there's 10 ice cream sandwiches in a box. So if he's asking $10 to mow the lawn, okay, that seems reasonable. I'll do it." And then you go to pay him. He's like, "No, no, no. You said ice cream sandwiches." "Oh, okay, okay." So you go to the store and you exchange the $10 for the ice cream sandwiches, which is what the kid really wants. Now, why is he doing that? Because he's a fat kid. His parents don't want him eating any more sweets and sugary snacks, and so he's just made an end regulatory arbitrage, and he's gotten you to buy the ice cream sandwiches that he wants. Would anyone say that somehow ice cream sandwiches are displacing or replacing the dollar? Nope. Um, it's just a conduit for the payment of dollars, or you bought him what he really wanted in the end anyway. What really matters is not the currency that changes hands for the transaction. It's the currency that both parties choose to hold. The buyer chooses to hold it before the transaction up until the moment of the transaction, and the seller chooses to hold it right after the transaction. And I reference it that way because all the currencies, all the major ones, are tradable in very liquid markets. I mean, at the institutional level, really really tight spreads. So if you want to hold dollars, you hold dollars. If you have to get euros at the last minute, or you have to get whatever at the last minute, you'll dump the dollars and get that at the last minute. And then what does the other party do? Does he turn right back around and trade that currency for dollars again? And so I don't think there's any desire. Certainly, I didn't see it in let's say UAE as an example. I haven't been to Saudi yet, but UAE is similar culturally anyway. I didn't see any desire to hold yuan. Everybody's balance sheet is denominated in dollars. I mean, you talk to family offices, you talk to pension funds, whoever you talk to, if there's a major balance sheet, it's dollars, not yuan, not real, not dinar, not whatever, dirham, it's dollars. And I don't think anything's changing. I think people make much ado of this petrodollar. There was a deal that the Nixon administration, I think it was Kissinger, cut with the Saudi king at that time. And at that time, things might have seemed to be, pretty fragile. It might have seemed to be a pretty tender moment. I suspect things were a little bit less fragile than everybody might have feared. But Nixon and his administration knew that they had just pulled the crime of the century by making the dollar irredeemable. And so they were running around desperately trying to prevent the consequences from being any worse than they already were going to be. While Nixon gets on TV and lies like a mendacious fool and says, "Oh, yeah, if you buy American, you're not going to feel any effects of this whatsoever." You know, Meanwhile, thus began the greatest episode of inflation the U.S. has ever faced. But as tender that moment may or may not have been in 1971, it isn't today. The dollar has the status that it has, not because the Saudis unilaterally agreed with Kissinger, to honor a certain thing or price it in this versus that. The dollar has the network effect. It's so powerful that I argue there's basically only one currency, and that's the dollar. All the others are local scrip, like a company coal mining town in West Virginia. And I imagine, I mean, I don't know, but some of those people might have been so ignorant as to think that their coal mining company was so powerful and so strong, this paper script was going to replace the dollar. Maybe some of those people sat around drinking in the bar at night and said that to each other. But do you know the name Jeff Snyder? I had him on my
Yeah, yeah, I
podcast.
know Jeff. I don't know
He
him personally, but I know who he is.
talks about the euro dollar. So I'd said, look, all the other currencies are local script and they're dollar derivatives, anyways. And he said, do you know what percentage of all the global derivatives book, which is approaching $1 quadrillion, do you know what percentage of derivatives trades have the dollar on at least one side? I said, I imagine it's got to be over 90%. He said it's 98 point something percent.
Wow.
It's basically there's the dollar and then that's it, full stop. And the idea of the dollar is going to somehow be displaced by some other paper currency. It's just, of all the things we got to be thinking about, man, that is number 742 on the list. I'd focus on the top 10, is what my advice would be. It just isn't even conceivable. There's one thing that could replace the dollar, that will replace the dollar. It's not the euro, it's not the yuan, it's not the ruble. I remember when Putin started his war, and then everyone said, I think Biden said that the ruble was going to crash. And so I don't know who manipulated what, but suddenly the ruble got very strong for a couple of months. And then it resumed its long-term, decline, in which it remains, even today. There's one thing that's going to replace the dollar at the end of the day, and that's gold, not some dollar derivative paper currency. Which is kind of like, if you think that Apple is going to die, so Apple shares are going to go to zero, you wouldn't be cheering Apple call options. So Apple call options are a derivative of Apple shares. If you think the underlying Apple shares are going to zero, you wouldn't be trading in the calls. And that's what the euro, the pound, the yuan, the yen, they're all dollar derivatives.
So what should be on the radar screen for precious metals buyers and just your general investor out there? Where should their sensors be kind of inclined to at this very moment?
Um, I think crisis is likely to drive more people to buy gold. And so yeah, it's kind of an unfortunate thing. I mean, in that sense, if you're betting on the gold price, you're almost betting like you're going to the craps table and you're putting your $1,000 down on do not pass. And all the other players are looking at you like, you son of a bitch. It's kind of an antisocial kind of a bet to make, right? Um, as calamity rises in the world, the gold price is going to rise because people are distrusting government. They're fearing their neighbor. They're fearing what's going to come in the future. It isn't a good thing. Um, of all the indicators that are out there, I think it's not a timing indicator, but Monetary Metals publishes the gold basis among many other charts, all for free on our website. Um, and that's the indicator that really tells you what's going on with the supply and demand fundamentals. Everything else is either kind of misleading when someone says, "Oh, look, the Irish Central Bank just bought 7 tons." It's the famous buyer fallacy. Okay, so Irish Central Bank bought. Okay, that's nice. Who sold? Okay, well, there's 100,000 anonymous people that each sold 7 ounces or whatever. Um, how do we know that they're all wrong? The Irish Central Bank is right. So, the fact that, I mean, it's true the Irish Central Bank bought, but it's not of any price predictive significance. Then there's a lot of other things that people say that just aren't even true or that are twisted into something that's misleading. But if you look at the gold basis, it's telling you the truth of what is going on with supply and demand. And to oversimplify it, if you see the basis rising, then you see that abundance of the metal to the market is rising. If you see the basis is falling, then abundance is falling, and that's predictive of what is likely coming next for the price. So we've boiled all that down into something we call the monetary metals fundamental price, which is a model that attempts to calculate, in the futures market, people can use really high leverage. They can use 20-to-1 leverage typically. So a 20-to-1 leverage, it doesn't take that much capital to at least temporarily stretch the market. I kind of imagine you have two steel posts and you have a rubber band stretched between the two posts. there's sometimes when the futures market is optimistic, and that's like somebody's kind of pulling up on the rubber band, and there's other times when it's depressed and it's pushing down on it. So this is a model that attempts to back out the effects of what's going on in the futures market to figure out where metal would be clearing if you didn't have a futures market on leverage. So I always preface this by saying there was a guy named Box, that data science and machine learning people would all know, statistics people, who said all models are wrong, some models are useful. We have a model in that spirit. Um, the absolute price level that the model predicts isn't, necessarily going to come true, ever, and certainly not necessarily by tomorrow morning. But if you see a trend where the price is moving in one direction, consistently, then that is likely, and the market price isn't moving yet. That's likely a tradable signal. So, for silver, we currently have a little over $36, and for gold, we have a little bit under $2,800. So, which is consistent with, my view as an economist that I think this is not the bear market of, let's call it, August 2011 through 2018, 2019, which was a sell the blips market. Every time the price would go up, everybody just trusted it. They'd go sell, and that was the right instinct if you're trading. I think we're in a bull market, let's say post COVID as a bull market, and consistent with that is the fact that prices have come down a little bit, but the fundamentals haven't. And I think we're likely to see blips in both prices, as a result of that.
I appreciate that call out, that quote there. I am a data scientist, so I do appreciate some of the things that you said there. What inning would you say we're in this precious metals bull market, though? We are in a bull market, but where do you think we are?
That's a really good question. I'm trying to put innings on it. I mean, in a certain sense, it might not end, and that is, this could be kind of the final. I mean, it could take 10, 20, 10, 20 years, but the final decline of the dollar, where you don't really see. So I look at the gold price as really the inverse of the dollar price. I mean, to measure gold in terms of dollars, it's like you're standing on the deck of a ship, which is slowly sinking because it has leaks in it, and it's tossing around in stormy seas. And you're measuring the altitude of the lighthouse relative to the deck you're on. And we're saying, the lighthouse is going up right now. When is it going to start going down again? And I just think we have the wrong perspective on it. And my concern would be that this is kind of it, and we're spiraling down. I don't know that. If you asked me in 2012, I would have thought we had maybe 7 years left, and this whole system was going to collapse. And obviously, that proved to be quite the underestimate. And I think, the lesson of that story is that that they keep kicking has a lot of kicks left in it still. But I think in terms of price action, there's quite a ways to go yet, because what's going to change that would get gold back into a bear market? What's going to change right now? Well, it's hard to even conceive of what that answer would be. So the gold price is up, yes, but I think can go a lot more. In other words, I think the dollar could fall a lot more, which is, again, worrying. Be careful what you wish for.
Keith, this has been an amazing interview. I appreciate your time here. Any closing thoughts before you wrap things up?
So one thing that we're super excited about, monetary metals is all about trying to bring gold and silver back as money, and not just as a dry asset that Warren Buffett says it's absurd, it has no utility, it's neither procreative nor productive. The same lump of gold sits in your desk drawer for 20 years, all the crap that he's said over the years. And we're trying to bring it back in the use in the financial system, and ultimately as money, by paying interest on it. We think interest is the key. So we've done some gold bonds. The first gold bond we did, I believe, was the first in 80 something years. We now have a silver bond, which we can openly talk about. We're raising a silver bond for a mining company called Bunker Hill. We can openly talk about this because we have a regulatory pathway to do so. And I believe that's the first, so we're paying 12% interest on a 3-year silver bond in silver on your silver. So you put in 1,000 ounces of silver, and then you're getting 120 ounces of silver per year as the interest. I believe that would be very likely the first silver bond in probably 190 years. And the reason why I say that is, the UK demonetized silver in the early 19th century. By the Coinage Act of 1834, the US effectively did so as well, because they undervalued silver as money as coin, and therefore the silver wouldn't come into the monetary system anymore. It would go to world markets where it's worth more. And so having done that, gold, collects in the banking system, but not silver. Of course, the bonds and lending and borrowing would be with whatever money the banks had, which was gold at that time. So my guess would be, and I haven't exhaustively researched this, I've done a little bit of Googling. My guess would be that there weren't really such a thing as silver bonds after 1834. So we're doing something very historic as well as something that, appeals to investor self-interest. And so thanks for giving me the opportunity to share that.
100%. Well, guys, if you enjoyed this interview, write "Go Keith, go" in the comments. Go Keith, go. And also, don't forget to like this video. Subscribe to the channel if you haven't already. Let's get those subscriptions up. 85% of you guys who watch this channel are not subscribed. So hit that subscribe button. Boost us up in the algorithm. We'll be able to get more guests like Keith on the show. Appreciate you as always, guys. And I will see you in the next episode. Bye, y'all.